Hello, welcome to financial statements. The first part of this class is going to have an introduction to financial statements in this module, and then the next modules are going to go through all the different financial statements. Why financial statements? Well, one reason is that you want to know how much money you're really making in your business. Without doing some analysis and having an understanding, it's difficult to know if you're truly making money. You also want to know if what you're doing is feasible. Can we pay the bills? Do we have enough cash around to meet our obligations when they're due? You also want to know how your wealth is changing from over time. Are we becoming more wealthy or less wealthy? Is our business growing? And you want to be able to compare between years and see trends. So these are all reasons why it was important to do financial statements. Overall, the goal of financial statements is to facilitate an accurate analysis of the financial position and performance of an operation. So when we think about it, financial position, it is a point in time, and performance is over a period of time. So really, financially, where do we sit, and what do we look like at certain points, and how do we perform over time? Are we getting better? Are we helping, making money, or not? So what are the 4 financial statements? And hopefully, because you're in this class, you've had your prerequisites and you know what they are. So can you name them? Balance sheet, income statement, owner's equity statement, and statement of cash flows. We're going to go over each of these, and like I said before, you're going to have a module on each one of those individually, and this is just an introduction overall. We need to know what is the purpose of each statement. The balance sheet is at a financial position at a point in time. It tells us what we have and owe. And so you're going to have assets, what you have, and you owe money to other people, which is your liabilities. And the net, the difference between the two, is your wealth or your owner's equity. The income statement's over a period of time, and so it's going to tell you how much money was earned, and that may not be received, but it's earned, and so it's your profit over time. And the owner's equity statement reconciles the equity at the beginning of a period with the end, so that's really going to tell you what happened to your wealth. Where did it come from, and how did it change over time? The statement of cash flows also is over a period of time, and it's going to reconcile the change in cash from one balance sheet to another. This is important because it says how much cash came in and how much cash do we use for different things, and that's going to help us understand if we've got the cash to meet obligations. Another way to look at this is to see the periods of time. And so you have statements at positions, statements at a point in time. So you have a beginning balance sheet, an ending balance sheet. So December 31st, 2010 is the beginning one. December 31st, 2011 is the ending one. So these are exactly a year apart, so it's a beginning and ending balance sheet. During that year, what happened during 2011, you have flow statements. So therefore a 12-month period or for the year. The income statements measuring your profit, how much profit was made from our production over that year. The statement of cash flow said what happens to our cash, so it's going to take the cash from here and the cash from here and show you how we got from one to the other, what we made cash from and what we used cash for. The statement of owner's equity is going to look at the wealth at the beginning and the wealth at the ending, and it's going to show you how your wealth changed and from what sources and amounts. And this is nice to be able to see because really over time you want to see your wealth increase, and it's nice to know where it came from and what's affecting that. Business versus personal is one consideration in making your financial statements. Do you want just the business assets, or do you want the personal assets on there? Usually it's useful to have just the business because we can compare the business over time and it should really stand on its own. But sometimes, especially in those early years, you may have to use personal assets as collateral to show that you own them so that you can obtain financing. And so in this class, we're going to show you how to have just the business, but also how to add some personal stuff in there too. The standards for financial statements. Standards are the assumptions made and determine the amounts and timing of things to include. So amounts and timing. Amounts are how we value assets. Timing is when we include them. So how assets are valued and when is revenue included. The timing of when it's included. Accounting uses generally accepted accounting principles. but we have special ones that are our standards for farming, and that's Farm Financial Standards Council, FFSC would be its acronym. And we are going to use Farm Financial Standards Council standards in this class, but we're also going to show you how they differ from GAAP and what that means. Cash accounting is just keeping track of cash transactions and has revenue and expenses that are the cash that received. So it's really just checkbook accounting. The problem is it doesn't really give you an accurate idea of really how much profit you made from what you did, because they can be distorted. Accrual accounting, on the other hand, uses inventory values, and we adjust the cash amounts to reflect what truly happened. So it's actually what happened during the period, and it's going to match revenue with expenses. In this case, the revenue of producing a crop and the expenses of growing it. So we're using accrual accounting, and we want to match up the expenses with the revenue. Here's the example. A potato farmer sold $550,000 of potatoes during the year and spent $250,000 on seed, fuel, and fertilizer and other expenses. During the year, the beginning inventory of potatoes, comparing it to the ending, he added $120,000 of potatoes to the balance sheet over the course of the year. The money owed, the accounts payable and related expenses, went down by $15,000. So the question is, what's the true revenue and expenses for the year? The revenue is going to be $670,000. The $550,000 that was sold plus the $120,000 put into inventory. So really, during the year, he must have produced $670,000 worth of potatoes. Expenses would be $235,000. The $250,000 purchased, less the $15,000 of that money used to pay bills from last year. The amount owed on those expenses went down by $15,000. So that $250,000 that was spent, $15,000 of that was really spent paying last year's bills, and so the net $235,000 is what the expenses actually were. Without the accrual adjustments, revenue expenses would be distorted, and it would be difficult to find out what was actually happening. That's why it's really useful to have accrual accounting and why it's more accurate. And one of our standards was the timing. When do we recognize revenue? When is it included on our income statement? Our options are when it was sold or when it was produced. And think about what you would like the income statement to tell you. If you'd like it to tell you what profit was made from what was sold, or was the what profit was made from what was produced. What really is the difference? This might be another place where you want to just pause and think about it for a second. FFSC recognizes the revenue income from a product when it was produced rather than when it was sold. So GAAP's going to include it when it was sold, but the Farm Financial Standards are going to recognize it when it was produced. This means that the profit on the income statement for farm records or farm situation is going to be recognize the value of the production over the course of the year. So 2011's income statement is going to recognize 2011's crop production and the cattle that were raised. GAAP would recognize the products that were sold during 2011, not what was produced. So if products were held over from the previous year, they would be not in GAAP, wouldn't be considered on the income statement until they were sold. The reason that we like to do it this way for farming is because we allows us to compare our profit from production of each year regardless of when it was sold. This is going to help us compare what are we making from our production from year to year to year. And if we did it when it was sold, it'd be easy to manipulate that. So an example, a grain farmer would recognize as income the value of the grain produced each year, even if they store part of it to sell in a future year. This is possible because agricultural products are commodities. This is important. They're commodities and a ready market exists. if you're producing cars, just because you produce it doesn't mean you can sell it. And so by showing income from production, you could really distort that income statement, and it's really not based upon having a market there. In agriculture, if you're selling commodities, there's always a ready market existing, and so really, as long as you've produced it, then you can show that you have the profit from it. So that's the trade-off. Both GAAP and Farm Financial Standards Council are using accrual accounting to match the revenue and expenses. We're both matching revenue and expenses. The difference is GAAP is including in revenue the value of what was sold, and in expenses the cost of producing what was sold. Farm Financial Standards is including in revenue the value of what was produced and matching the expenses to include the cost of what was produced. So under GAAP, the seed used to grow wheat would not be included in expenses until the year it was sold. Under Farm Financial Standards, it's included in the year the wheat was grown.